Hi, my name is Lisa. Welcome to this journey through commerce. Today we're going to dive into a really exciting and practical topic. Investment Management, Part 1. Part of your course, Finance, Futures, and Global Systems. In this session, we'll discover what investment really means, how portfolios are managed, explore tools like mutual funds and ETFs, and even take a peek into careers in this field. This session is your first step into the world of managing money professionally. We'll be looking at how investments are planned, where money is placed, and how it can grow over time. You'll also learn why this knowledge is important for your future financial decisions. Whether you want to work in finance or just be smart with your own money, this chapter will help. Let's dive into the concepts that shape modern investment. What is investment management? Investment management is the organized way of growing and protecting money. It includes selecting the right assets, making smart decisions, and reviewing performance over time. Whether you're an individual or a large company, managing investments helps you reach financial goals. Professionals known as fund managers often do this work. It's like hiring a coach to guide your money to success. Importance of investment management. Why does investment management matter? First, it helps your money grow instead of just sitting idle. It also supports economic development because investments fund businesses. It creates financial security for your future, like for college, emergencies, or retirement. Good management means smarter decisions and better outcomes. So yes, it's very important. Key components of investment management. There are 3 key parts: assets, strategy, and goals. Assets include stocks, bonds, and real estate. The strategy is how you choose and balance these assets. And goals keep everything focused. Maybe you're saving for college or a house. Together, these help build a solid plan for your money. It's like building a tower. Strong pieces and planning are essential. What is a portfolio? A portfolio is your collection of investments, like a basket with different types of fruit. It might have shares of companies, some bonds, maybe even property. Keeping a mix helps lower risk. If one investment fails, others might do well. A portfolio is always changing, like a team lineup in sports. It's updated to improve performance. Diversification explained. Diversification means not putting all your eggs in one basket. By spreading money across different areas, you lower your risk. For example, if one stock goes down, another might go up. It's a smart way to protect your overall investments. Think of it as balancing. It helps keep your financial journey steady. Asset allocation basics. Asset allocation is how you divide your money into different types of investments. For example, 50% in stocks, 30% in bonds, and 20% in savings. This balance depends on your age, risk comfort, and goals. Younger people might take more risks, while older people may choose safer options. The right mix gives you better chances of success. Mutual funds introduction. Mutual funds pool money from many people and invest in various assets. A professional manager decides where the money goes. You own a small part of everything the fund invests in. It's safe, easy, and great for beginners. Plus, you get diversification without doing all the research yourself. Exchange-traded funds, ETFs. ETFs are like mutual funds, but you can buy or sell them anytime on the stock market. They are cheaper and more flexible. You still get a mix of investments, but with more control. Many people like ETFs because they offer simple access to many assets. They're a great starting point for young investors. Hedge funds explained. Hedge funds are for experienced or wealthy investors. They try to earn high returns using advanced strategies. These funds take more risk and charge higher fees. They're not for everyone, especially not beginners. But they're important to understand because they influence financial markets. Comparing investment funds. Let's compare. Mutual funds are easy and managed by experts. ETFs are cheaper and more flexible. Hedge funds are risky and mostly for rich investors. Each has its pros and cons. Your choice depends on your goals, money, and risk comfort. Understanding risk appetite. Risk appetite is how much loss you're okay with in hopes of gaining more. Some people are okay with big ups and downs, others are not. Your age, goals, and savings affect this. If you're young, you might take more risk. It's all about knowing what makes you comfortable. Return expectations. Investing is about expecting returns, or profit. Stocks often give more return than bonds or savings, but more return means more risk. Set goals that match reality. Smart investors know that slow and steady can also win the race. Risk versus return. High returns often come with high risks. Safe investments give low returns but are more stable. You need to find a balance. Don't chase high profits blindly. Always ask, is this risk worth it? Performance metrics. How do you know if your investment is working? Use metrics. NAV tells the price per share of a fund. CAGR shows how much it grows each year. The Sharpe ratio tells you if your risk is worth the return. These tools help you measure success. Fund strategy types. There are different strategies. Active funds are managed daily by experts to beat the market. Passive funds just follow a market index like the S&P 500. Growth funds pick rising stars. Value funds pick underpriced but solid companies. Choose what fits your style. Role of fund managers. Fund managers are professionals who plan, research, and manage portfolios. They study the market and make smart decisions. They also talk to clients and explain how things are going. They're like coaches, guiding your money to success. It's a serious and rewarding job. Wealth management careers. There are many careers in investment. Financial advisors help people plan money goals. Analysts support fund managers with research. Planners give long-term advice. If you love math, analysis, and helping people, this field is for you. It's a growing and exciting industry. Skills for investment careers. Want to work in finance? You need analytical thinking to study trends. Communication helps explain ideas clearly. Knowing Excel or finance software is a bonus. Build these skills in school now. They'll help you in many careers, not just finance. Real-world applications. Some schools even run student-managed funds. Students pick stocks, track results, and learn from real-world experience. It's hands-on learning. These activities make financial learning exciting. You can see how theory turns into action. Summary and key takeaways. We've learned a lot today. What investing is, how it works, and the tools professionals use. You now know about portfolios, mutual funds, ETFs, risk, return, and careers. These ideas will help you manage your own money smartly. Finance is not just for bankers, it's for everyone. Thanks for joining me on this journey.